Welcome to this explainer. Today, we're putting on our detective hats to investigate a seriously fascinating financial mystery. So picture this. The closing bell rings in New York, traders pack up for the day, and Wall Street goes to sleep. But over in a completely different corner of the financial world, major tech stocks are still trading 24 hours a day, 7 days a week. It kind of makes you wonder, right? What exactly happens to the price of a stock when the actual market for it is totally closed? Do things just go off the rails, or does the market efficiently price in the night's news? Well, we are going to look at a brilliant empirical study that tracked exactly what went down when tokenized equities started trading in the dark.
To really grasp the massive scale of what we're looking at, we have to rewind a bit to July 1, 2026. That is when Robinhood Markets launched the Robinhood Chain. Basically, it's an Ethereum Layer 2 network that was built specifically for autonomous agents and retail wallets to trade synthetic U.S. equities continuously. And I mean continuously. This was definitely not some tiny under-the-radar experiment. Within its very first week, the network processed several million transactions and pulled in hundreds of millions of dollars in deposits. Okay, let's dive into this and figure out how exactly this massive machine operates under the hood.
Section 1. The 24/7 Trading Revolution. Let's start our investigation by looking at the fundamental landscape of these continuous markets and defining what these synthetic equities actually are.
Now, when you buy a token for, say, NVDA or Apple on this chain, you've got to remember you aren't actually buying a piece of those companies. What you're really buying is a tokenized debt security. Think of it almost like an economic wrapper. It's issued out of Jersey, and its value is legally designed to track the underlying stock. But, and this is a big but, it grants you absolutely zero direct legal title, no beneficial ownership, and for sure, no voting rights. It is strictly a price exposure vehicle. Sure, this wrapper is incredibly convenient because you can trade it anywhere, anytime on a blockchain. But as we'll see, that convenience introduces a massive structural quirk.
Section 2. The Missing Arbitrage Mechanism. And it's this exact structural quirk that brings us to the prime suspect in today's mystery.
Let's compare how traditional financial wrappers work versus these new crypto stock tokens. When you buy a traditional exchange-traded fund, an ETF, its price stays anchored to the actual underlying assets. Why? Because of a direct creation and redemption mechanism. If the ETF price drifts too far away from the fundamental value of its stocks, big institutional players just step in, buy the cheaper asset, sell the more expensive one, pocket the difference, and snap the price right back into place. But contrast that with Robinhood stock tokens. Yes, they trade 24/7 on decentralized exchanges, but that direct creation and redemption mechanism, it is completely restricted for retail users. You literally cannot just take your token to the issuer and swap it for a real Apple share. In traditional finance, there's basically a highly exclusive VIP list for fixing these prices. Only a select group of institutional players, known as authorized participants, have the power to create or redeem tokens directly with the issuer. They are the gatekeepers. They're the ones arbitraging away those price deviations to keep the token perfectly anchored to its fundamental value.
But here's the catch. Those gatekeepers mostly only operate when the traditional stock market is open. So, the crucial point is this. Retail traders are completely locked out of this direct redemption process. Imagine you're a retail trader trying to make moves on a Sunday night on the blockchain. If the token price gets completely detached from what the stock was actually worth on Friday afternoon, you have zero arbitrage channel to fix it. That mispricing, or the basis as it's called, can persist all weekend long until Wall Street reopens on Monday morning. This creates a really dangerous window that the researcher calls the redemption gap.
Section 3. Trading in the dark. Let's actually look at the data collected from the very first week of trading to see what genuinely happens in this unarbitraged darkness.
The researcher poses a really brilliant rhetorical question here. Since retail is locked out of fixing the price and the underlying stock market is fast asleep, does the token's price just drift wildly all night long? Or is the market actually smart enough to just hold tight, keeping the price super stable while it waits for the morning bell in New York? Well, the initial hypothesis was definitely that these tokens would be way noisier and much more volatile when the main exchange was closed.
Now, what's really interesting here is that the data showed the exact opposite of what you might expect. During the hours the traditional market was open, the NVDA token's return volatility was nearly 1.37%. But when the market was closed, during the dark hours of that redemption gap, the volatility actually plummeted to just under 0.58%. And it wasn't just NVIDIA. 4 major tickers, NVIDIA, Google, Tesla, and Meta, all showed this statistically significant pattern. Think about that. They're actually wilder in the daylight and calmer in the dark.
Section 4. Mispricing or stale artifact. Okay, before we go rewriting the finance textbooks on market psychology, we have to interrogate this data. Is this lower nighttime volatility a sign of a highly efficient market, or is it just a mechanical illusion? In the nerdy world of market microstructure, there's this phenomenon called non-synchronous trading. Basically, when a security is traded very thinly, meaning hardly anyone is actually buying or selling it, the price can look incredibly smooth and stable over time. But it's not stable because everyone perfectly agrees on the fundamental price. No, it's stable because literally no one is trading it. The price just becomes stale between those infrequent trades. So the researcher had to figure out, is this low volatility in the dark genuine, or is it just a stale artifact of zero-volume trading hours?
To solve this puzzle, the researcher ran a really clever active candle retest. They filtered the data to look only at time periods where actual trading volume occurred, and the results were wild. For Tesla, that apparent nighttime stability, completely fake. Once they stripped out the hours where no trades happened, which accounted for a massive 42.7% of Tesla's off hours, the volatility difference vanished. It was a total illusion. But then, look at NVIDIA. Even when you only look at active trading, the pattern completely survives. The NVIDIA token genuinely behaves differently and more volatilely during open hours. And Apple? Apple is the weird outlier of the bunch. Its volatility actually was higher in the dark, and that reverse pattern actually strengthened in the retest.
And this brilliantly illustrates what Apple looks like in practice. You can clearly track how the chain token generally follows the actual stock level, but then you see these visible short-run deviations, these basis gaps, where the token price completely disconnects from the equity price by a few percent in either direction. This isn't theory. This is real, measurable mispricing happening in real time purely because that retail arbitrage channel is bolted shut.
Section 5. The placebo benchmark. All right, we've seen that some tokens really do act fundamentally differently between open and closed hours. But get ready, because here comes the final, shocking twist in our empirical investigation.
The researcher asked a truly vital question at this point. Okay, we know the NVIDIA, Google, and Meta tokens are more volatile during primary trading hours. And we originally blamed this on the unique, restricted structure of Robinhood's crypto tokens. But what if we checked a traditional financial asset? One that has perfect, unrestricted arbitrage? Would it behave differently? To find out, they set up a placebo test using the SPY ETF, which tracks the S&P 500.
The results here completely reframe our entire investigation. SPY has a perfectly functioning creation and redemption mechanism. But just look at the numbers. SPY's volatility during open hours was 0.158%, and during closed extended hours, it was 0.062%. It shows the exact same directional pattern as the restricted crypto tokens. The open market volatility heavily exceeds the closed market volatility, meaning the wildness of daytime trading isn't just an artifact of Robinhood's restricted token structure at all.
Which brings us to the final verdict of our explainer. The reality is, primary trading hours simply carry more price-relevant order flow, more breaking news, and way more human activity for virtually any instrument, whether it's a tokenized real-world asset or a completely traditional ETF. Now, the researcher did note that when these tokens drift in the dark, they do tend to snap back and correct toward the fundamental stock price when the market finally opens. In fact, the data shows a negative drift gap with a beta of negative 0.447 across 29 transitions, which is approaching statistical significance. But the core finding on volatility? The real culprit is just daylight human activity.
So as we step into this brave new world of always-on, blockchain-based equities, we really have to ask ourselves, are 24/7 markets truly the democratized future of finance? Or, by locking retail out of the underlying arbitrage mechanisms, do they just expose everyday investors to wider, unfixable price gaps in the dark, just waiting for Wall Street to wake up and correct the record? It's a massive structural tension, and it's absolutely crucial to understand as more real-world assets move on-chain. Thanks for joining me on this deep dive. Keep questioning the data, and I'll catch you on the next explainer.